Have you ever considered the ripple effects when governments decide to increase taxes, and how that might touch everyone in an economy? Generally speaking, yes, tax increases can contribute to an overall economic slowdown. This is not a simple yes or no answer, as the actual outcome depends on a complex interplay of various factors. The core mechanism is rooted in how taxes influence aggregate demand and supply. When taxes on individuals rise, their disposable income decreases, which typically leads to less consumer spending. When corporate taxes increase, businesses may have fewer funds available for investment in new equipment, research and development, or hiring new employees. Both reduced consumption and reduced investment lead to a contraction in aggregate demand, meaning a lower overall demand for goods and services in the economy. This shift in aggregate demand can reduce economic output and potentially increase unemployment. Furthermore, high corporate taxes can disincentivize long-term capital investment and innovation, affecting the economy's productive capacity or aggregate supply over time. The impact also hinges on the specific type of tax increase, such as income tax versus a sales tax, the magnitude of the increase, and the prevailing economic conditions, such as whether the economy is already in a recession or experiencing a boom. Economists and policymakers analyze the potential effects of tax increases using sophisticated economic models and by closely monitoring key macroeconomic indicators. They look at data like gross domestic product, unemployment rates, and consumer confidence. However, isolating the precise impact of a single tax policy change from other economic variables is a significant challenge. This concept ties into the idea of the fiscal multiplier. A tax increase can reduce gross domestic product by more than the initial amount of tax revenue collected, particularly if households have a high marginal propensity to consume. Different schools of economic thought, like Keynesian economics, often emphasize the demand-side effects, while supply-side economics focuses more on how taxes affect incentives for work, saving, and investment, thereby influencing long-term growth. Understanding these distinct perspectives provides a more complete picture. Ultimately, the decision to raise taxes involves a careful balancing act for policymakers. They must weigh the need for government revenue, perhaps to fund public services or reduce national debt, against the potential for dampening economic activity. Appreciating this intricate relationship between fiscal policy and economic performance is fundamental to understanding macroeconomic dynamics.